In this video, we're going to talk about combining both the deltas and the DTE together. Let's jump into it. Great, so let's look at the deltas right over here. So if you remember, the deltas, we're aiming for 15 to 50, even though I don't really spend much time there. I try to stay in the 30 delta range. So this is kind of the delta sweet spot. And if absolutely needed, I'll go higher, but I almost never go this way. But I do sometimes go above to go to the 50. Great. Now theta, we're going to use 45 days to expiration here, all the way to 0. So this is really exciting because based on what you're trying to do, you can actually combine the deltas and thetas together to generate the best possible outcome for your trading strategy. So if you have high urgency, then you would trade higher deltas and lower theta. Now remember, this lower theta, that's what this is. Remember, 0 DTE, that means it's expiring today. That means if you sold a put option and if it's in the money, that means you're going to get assigned the stock that day. If you sold a call option and if it's in the money, that means you're going to be obligated to sell that stock that day. So this is with high urgency because you're trying to buy the stock or you're trying to sell the stock based on whether you sold a put option or a call option. Now with higher deltas, that's this right here, this means there's a higher probability of it getting assigned because 50%, remember, it's basically a coin flip. That means there's a higher probability that your stocks can get assigned. So this is what you do with higher urgency, as in you want to buy stock today or you want to sell the stock today. And this is with a put option and this is with a call option. Now let's talk about low urgency. This is where we usually spend most of our time because this is a longer term strategy, right? So you want to keep a majority of your portfolio kind of in the low urgency space because this is where you're, long-term buy and hold. And so because of that, you would use lower deltas and you're going to use higher thetas. So again, lower delta right here, that's this right here. And the higher thetas, this is the higher days to expiration. And so based on what you're trying to do, again, you get to decide whether you want to do high urgency or low urgency. And this is meant for long-term growth. This is meant for short-term. So this way you could kind of fluctuate and position your portfolio accordingly. Awesome. Remember, this is all a sliding scale. You can decide what you want to do based on what you're trying to accomplish. Ideally, you just pick one number so you can execute these trades without really thinking about it, making it as automatic as possible. So I'd recommend picking a delta between 0.15 and 0.3. And for theta, again, based on urgency, I would pick a days to expiration between 0 and 45. I usually aim to be on the 45 days to expiration. However, based on urgency, again, I go shorter dated if I need to exit a position or enter into a new position. But I'm, again, a more active trader. And so based on what you're trying to do, pick a number and just stick with it. And I think a good place which you could actually just start out is 15 delta, 45 days to expiration. That way it's very consistent, very steady, and that way you could just focus on your life. But again, it really depends on how much involvement you want to have. I'll see you in the next video.